Hi again, this is Ron for Sharp Trader, and today we'll be taking a closer look at derivatives. Last lesson was an introduction to financial markets in general. There we took a very cursory look at the assets we can trade. We also looked at the differences between them and the derivatives that we base them upon. Today, we'll go a little deeper into that. As we mentioned in our first lesson, derivatives are financial instruments that investors can trade with. And roughly, we have 4 different kinds: forwards, futures, options, and swaps. A forward is a contract to buy or sell an asset in the future and for a predetermined price. A future resembles a forward, but it's never traded on an exchange. Rather, it's traded over the counter. Also, profit and loss in a futures contract is predetermined. An option is a future choice to buy or sell an underlying asset, but without obligation. And swaps are an exchange of cash flows obtained between 2 other financial instruments. Most online brokerages provide investors with access to options and contracts for difference based on shares, indexes, commodities, currency pair exchange rates, and exchange-traded funds. Again, we'll be taking a closer look at each of these later on. For now, we'll simply say that a CFD pays out the difference between the underlying asset's value when a contract is opened and when it's closed. Now, derivatives trading is actually older than shares. Shares were invented by the ancient Romans. The Greeks invented options. The story is that Thales, a Greek scholar, learned that the season's olive crop would be larger than normal. He therefore purchased options on all the olive presses in the land. And when the harvest came in, oil producers had to buy these options from Thales, who made quite a huge profit on something he actually didn't own. The beauty here was that the oil press owners were assured of their money even before the harvest came in. The olive growers ended up paying a bit more, but that was mainly because demand for the presses had grown. Only Thales was taking a risk. His information may have turned out to be completely wrong. So whether it's the tulip options bubble, the Dojima rice exchange, or 19th century bucket shops, the most important function of derivatives is to hedge risk. A produce wholesaler will ensure the price he'll have to pay when the harvest comes in by promising the farmer a little more than he expects. A farmer will be prepared to take a little less in case overproduction forces prices too low. One is the buy price, the other is the sell price. The former is the price at which the buyer can call upon the seller to sell him the asset. The latter is the minimum value the seller is prepared to put on his asset. Okay, now let's talk about swaps, because we will be talking about fees for keeping a contract open overnight. Basically, if you want to do that, your broker will be closing one contract when the market closes and reopening a new one when the market reopens the next day. If the value of the asset has gone up, we'll have to pay an overnight swap. If it goes down, we'll owe our broker a negative swap. In some cases, we'll be making a profit. And finally, there's the CFD, the contract for difference, which is actually a kind of swap. Originally, the CFD was defined as an equity swap between 2 respective cash flows. Now, the contract simply entails getting or paying the difference in an asset's value when the contract is opened and when it's closed. The CFD is just the latest in a series of financial innovations happening all over the marketplace. And without a doubt, as the world economy goes more and more online, as digital currencies replace paper currencies, and funding becomes more transparent, we'll be seeing more instruments created to answer the needs of the global economy. Meanwhile, CFDs are becoming extremely popular thanks to their affordability, accessibility, and the fact that they can be leveraged and traded on margin. What are those, you ask? Well, one thing at a time. In our next few lessons, we'll be learning about assets. See you then.